Listen to me, everybody. I need you to lean in and hear me loud and clear right now, because if you are retired, or if you are anywhere near that finish line of retirement, there is one thing keeping you up at night: fear. You look at the economy, you look at inflation eating away at your purchasing power, you see the stock market swinging up and down like a roller coaster, and you think, I worked 40 years for this money. I cannot afford to lose it. I get it. I understand that fear deep down in my soul. You want safety, you want security, and you want to know that the nest egg you sacrificed for is going to protect you for the rest of your life. And because of that fear, what happens? You turn on the television or open up your computer, and you are bombarded with slick, glowing commercials featuring famous actors telling you, protect your hard-earned 401k. Move your paper money into real, physical gold. Open a Gold IRA today before it's too late. It sounds safe, doesn't it? It sounds like the ultimate security blanket. But before you pick up that phone, before you write a single check, or before you sign away your hard-earned rollover dollars, you need to understand exactly how a Gold IRA works. Because if you do not know the rules, the hidden fees, and the tax traps, that security blanket can turn into a financial nightmare. So let's break down the truth, step by step, with no sugarcoating, so you can protect yourself and your money. First, what is a Gold IRA? A Gold IRA is simply a specialized, self-directed individual retirement account that holds physical gold, actual coins and bars, instead of traditional assets like stocks, bonds, or mutual funds. Now, when people hear physical gold, they immediately picture a box of shiny gold coins sitting safely in a safe at home or buried in their backyard. Stop right there. Listen to me, you cannot keep IRA gold in your home. If you buy gold through a Gold IRA and you put it in your house, in your personal safe, or in a local bank safety deposit box, the IRS views that as an illegal distribution. They will treat the entire amount as if you withdrew it. That means you will pay ordinary income tax on every single dollar, and if you are under age 59 and a half, you will get slapped with a 10% early withdrawal penalty. So how does it actually get handled? Under IRS rules, your physical gold must be held by an IRS-approved custodian and stored in an off-site, high-security facility called a depository. You never touch the gold yourself while it's in the account. The dealer sells the IRS-approved gold, the custodian processes the transaction, and the metals are shipped directly to that insured depository. Now, let's address the elephant in the room. How does money get into a Gold IRA? Most people do not open a Gold IRA with fresh cash. They roll over money from an existing 401k, 403b, or traditional IRA. If you do a direct rollover, where the money goes straight from your old custodian to your new self-directed custodian, it is a non-taxable event. But if you do an indirect rollover where a check is made out to you, you only have 60 days to get those funds into the new account, or taxes and penalties will wipe out a chunk of your savings. Here's where so many retirees get hurt, and this makes me so mad I could scream: the hidden costs and fees. When you buy a standard stock or bond index fund inside a regular IRA, your management costs can be virtually zero. But a Gold IRA is an expensive vehicle to operate. You have a one-time account setup fee. You have annual administrative fees paid to the custodian. You have annual storage and insurance fees paid to the depository to guard your metal. And worst of all, you have the dealer markup. Gold dealers sell gold above the actual market spot price. That spread between what you buy it for and what they will buy it back for means you start out in the red the moment the purchase goes through. If you put a small amount of money, say $20,000 or $30,000, into a Gold IRA, those flat annual storage and maintenance fees are going to eat up a huge percentage of your account balance every single year. You are starting off behind, fighting uphill just to break even. Gold does not pay dividends. Gold does not pay interest. It just sits there in a vault. To take your RMD or get income, you have two choices: either you have the custodian sell a portion of your physical gold back to a dealer for cash, and pay whatever markup spread they charge you on the way out, or you take an in-kind distribution. That means they ship the physical coins or bars to your house, but you still owe income tax on the full dollar value of that gold in the year you receive it. How are you going to pay those income taxes if all your money is tied up in gold coins sitting on your kitchen table? You would have to find a dealer and sell the gold anyway just to pay Uncle Sam. So, what is my takeaway for you? What should you do right now if you are worried about inflation and market crashes? Listen to me carefully. Gold can be a fine store of value, but it should never be your entire retirement strategy. Never. If you want gold in your portfolio as a small hedge against inflation, you do not need to pay massive custodian fees, storage fees, and dealer markups for a physical gold IRA unless you have a substantial portfolio and fully understand the costs. For most retirees, if you want exposure to gold, you can hold a low-cost gold ETF inside a traditional, low-fee IRA at a major brokerage house. You get the price movement of gold, you pay microscopic expense ratios, you have instant liquidity with zero storage fees, and when you need cash for an RMD or living expenses, you click a button and the money is in your checking account tax efficiently without dealer markups. If you do insist on physical gold in a self-directed IRA, never put more than 5% to 10% of your total liquid net worth into it. Keep the vast majority of your money in income-generating, liquid, low-cost investments that support your daily life. Do not let fear drive your financial decisions. Do not let aggressive salespeople push you into expensive accounts you do not understand. You work too hard for your retirement to hand it over in fees. Stand tall, ask the hard questions, protect your cash flow, and keep your hard-earned money safe.